If you want to be a millionaire, start with $1 billion and start a new airline. This was the quote from Sir Richard Branson, the founder of Virgin Airlines. I didn't fully understand this joke until I invested into AirAsia, which I thought was a good investment at that point of time. That investment did cost me a pretty penny in terms of losses, but it helped me redefine, helped me recrystallize how I think about investments and other businesses that I evaluate in the future. So I first explained my investment thesis when I looked into Asia and started investing in them. They started with a Kuala Lumpur hub in Malaysia where I'm based. And the investment thesis at that point of time was really Southeast Asia, a combination of nations that had a total population of roughly about 600 to 700 million. And these are all based in what we call archipelagos, which is islands. And the best or most efficient way of actually traveling was actually through air travel. Nobody with a rising income or being in the middle class would want to travel by boats. It's one, it takes too long, and secondly, it becomes riskier. AirAsia at that point of time was the dominant first mover low cost carrier. They literally borrowed the model from Ryanair or also Southwest in the United States, and they were growing their fleet size by leaps and bounds. The second investment hypothesis was that Southeast Asia was seeing a rise in the middle class that was eager to travel, and it was prohibitive in the past in terms of cost because all full-fledged carriers, as what we call them today, air tickets was just expensive. And with this lowering of airfares, it really lowered the barriers for this rising middle class to actually start traveling. The third reason was they were going to pay an attractive dividends of 90 cents on a share price of roughly 2 ringgit 10 cents. So it made it very attractive that if you're going to buy this share, you're going to get immediately some sort like a cash back of 90 cents dividend. But here's the painful truth about investing into airlines, or more specifically low cost carriers. Now you think about it, what is the inventory of a low cost carrier? It is literally seats, and they need to sell these seats, fully utilize the airplane in order for them to make money. But in reality, it's really a very low cost, low margins, high volume kind of game, because if you don't fill the planes and the planes are only 20% filled and your fares that you are charging are so little, you barely make even break-even point to cover your operating costs, which I'll cover in the next point. You see, for running an airline, what are your biggest expenses or costs? The biggest chunk is really aviation fuel. That makes up 50 to 60% of any airline costs. And in order for you to reduce your costs, you have to continuously renew the fleet, because as you drive older cars, definitely they are not as fuel efficient as newer cars. This same analogy applies to airlines, where you have to keep the fleet young, and also passengers would love to sit in a newer plane compared to an older plane, so you can fill the planes faster. So this relentless need for capex, relentless need to actually buy or maintain the youth of the fleet, so that your fuel costs, which is the biggest operating cost, can actually be lowered. But because of that, then you give rise to another problem, in which if you continuously need to buy planes, and you can't buy planes today and get them tomorrow, you have to buy them probably 5 years in advance, or maybe even 6 years in advance. And this perpetually fuels a debt cycle, because you are unlikely to make back that you can make an airline debt-free. I've not seen one debt-free airline before. And you do need that to continuously buy new planes. So there's this perpetual capex cycle, perpetual OPEX optimization cycle that any airline in the world, full-fledged or low cost, has to bear. Now just imagine if one day fuel cost goes up to 150 US dollars a barrel, either the Brent or the WTI, right? What happens to the operating costs of a particular airline? That's why I don't know if you remember, somewhere in 2015, 2016, when the WTI or the Brent, which is the benchmark for crude oil, actually shot up to almost 120 US dollars a barrel. That's where all airlines actually had to take a massive beating in terms of increased operating costs. They had to find ways to even pass on these costs through some kind of a fare increase to the passengers. Now knowing all these, if you want to evaluate any businesses to invest in, you have to prioritize a few things which I'm going to share here. The first one is really free cash flow. Apart from just looking at net profit, which in my point of view, it's an accountant's profit, you really have to look at what we call investor's profit, which is free cash flow. Now, for those of you unfamiliar with free cash flow, it is really operating cash flow net of all the capex expenses that you have to bear. So why is it known as investor's profit is because if a normal operating cycle, normal operating year, operating cash flow, I would simplify it as your day-to-day running business, whatever you make. But if you do need to expand the business and continuously maintain either a growth capital expenditure or a maintenance capital expenditure, your free cash flow is the number that you should be looking at because it is operating cash flow, your yearly year in, year out kind of money coming in, and net off what you need to maintain or what you need to grow the business. That is your real investor's profit. So for an airline, you will see their free cash flow fluctuates from negative to positive and negative again. And why is that? Think about it. On the years when they have to take on delivery of planes, you remember the planes that they ordered 5 or 6 years ago, they have to start paying down this capex. And when you have, let's just say 2 billion of operating cash flow a year, and your capex cost for that year came up to 3 billion, your free cash flow is actually negative. 2 minus 3 is negative 1. And that cycle will just perpetuate until you don't have to take on new delivery of planes. But remember I said earlier, if you don't maintain a new fleet, your operating costs, especially fuel, will go up because you have an airline running with older planes and inefficient use of fuel. So in terms of moat, low-cost airlines or any airlines in the world doesn't really have even a low-cost advantage for LCCs or low-cost carriers because there's always this constant pressure of fuel costs that is beyond your control. There's always this constant pressure of increasing labor costs, especially in Western countries like Europe or in the US. There's always labor unions that are always fighting for an increase in salary. These are all perpetual problems globally for any airline, and that's something that diminishes any moat for airline business. You have to be looking at moats that are a little bit more powerful, things like switching costs or network effects for an investment hypothesis before you go into any company that you want to invest in. So any public listed company that has a great narrative or great story, remember that the story can only last for so long. Really understand your financial statements, the unit economics and the business model, because that is no substitute for a great narrative. Understand the balance sheet, understand the cash flow and how the business generates cash flow, because that ultimately is the real test of time to make that investment sustainable. So the challenge for you now is this. Anytime someone presents or you find a great stock idea, before you get enamored or enthusiastic about the growth story or the big picture, pause and take a look at the unit economics. Do you really understand how does it generate revenue? Does it generate cash flow? And how much cash does it need to continue to sustain this business? If you can't answer these few basic questions, then it's better to say no, that you don't understand it and can come back to revisit it later, rather than just buy into that narrative and buy into that growth story. Oh, I'm going to grow 30% year on year. Okay, even if you grow 30% year on year, are you cash flow positive? Are you going to generate money enough to sustain even this business? So I mean, there are a lot of businesses out there that can grow 100% a year, but then sustain losses or sustain negative free cash flow. Is that really a good business that you really want to invest in? So that's my challenge to you. I've learned the hard way that owning an airline, no matter how exciting, often is really the business model that defines your investment hypothesis. So I no longer chase like big dividends. Actually, I'm more afraid of companies paying dividends because it somehow signals to me that you have no other way to deploy that cash, no other way to reallocate your capital to grow. And I don't really like, very high capex business today, unless I understand that high capex has somewhat a prevention or barriers to entry for new entrants, and these guys have to continuously put in high capex. That's fine, but now what I look for is really sustainable free cash flow and really a high margin kind of business. Growth can be tempered with valuations, how much you're willing to pay for it, but there you go. My thoughts on Asia. What do you guys think? What are the investment kind of mistakes or lessons that you have learned in the past? Share with me in the comments below.